Goods producers also made deeper cuts to their purchasing activity and stock levels during the penultimate month of the year. The decrease in post-production inventories was the joint quickest for more than 3 years, while stocks of input fell at one of the fastest rates since 2009. Now you think about this, why aren't they building inventory here? Well, if prices and demand were rising, well, they would want to build inventory now at a lower price to eventually sell it at a higher price as demand increases. The problem now is they're seeing prices decrease, and they don't want to get stuck with expensive inventory. And again, if you're not building inventory, if you're not clearing through backlogs, and you don't have enough new orders, well, it means you don't need a lot of workers either, and that's exactly what's hitting the factory sector there. Firms reported reducing inventories not only because of decreasing demand and production requirements, but here's a big one, but also to save costs and due to improved material availability, suggesting, as we know, input prices heading down, no need to build inventory. The situation for the German industry is looking pretty grim, as people feeling the pinch, as reports of companies in the manufacturing sector now planning massive job cuts are coming in almost daily. So here you can see the emergency warning flashing over the German economy, potentially making them one of the first to head into an all-out recession, and this is dangerous for the global economy. The PMI employment index backs this up, showing a trend of accelerating staff reductions since mid-2023. So far, this has only slightly impacted the unemployment rate, but makes it even more urgent for the new federal government to take action and boost Germany's competitiveness. New orders aren't dropping as fast as they were in recent months, but that's little consolation when we look at foreign orders alone. Now think of this, that's outside Germany, that would be Asia, that would be the United States. Look at this, the situation has gotten worse. The slight speed up in delivery times also points to weakening demand, and that's spreading across the Eurozone. Let's take a look at what happened in France. As factory orders in France now fall at the fastest rate since May of 2020, and what we're starting to see is there could be mass unemployment in the Eurozone, and if that happens, well, there's no way that Asia is going to get away with this and stay out of recession. Neither will the U.S. But we'll take a look at the U.S. data here in a moment. They note the sharpest drop in manufacturers' new orders since the first wave of COVID-19. Competitive pressures are driving firms to discount. Well, that's exactly what happens when you have increased competition, and further contractions in output are predicted. The November survey data indicated another considerable month-on-month reduction in new order intakes at French factories. The latest contraction was the steepest since May 2020, with panelists mentioning lower levels of new work from clients in both domestic and international market. Outside of France, the U.S. and Germany were cited as drags on export. So what we're seeing here is demand from U.S. consumers is plunging. Now, remember, there's a lot of competition for the U.S. dollar here from the U.S. consumers, because what's China doing? Dumping massive amounts of goods in the U.S. economy ahead of the potential tariffs. This is dangerous for the German and French economy, who are losing out. In fact, the data revealed the quickest decrease in sales to foreign customers in 4.5 years, indicating that perhaps we've hit an inflection point across the global economy and are about to make a large plunge lower. Factory employment continued to decline midway through the final quarter of 2024. In many cases, here we see the unemployment data again. Staffing numbers were lowered via the non-replacement of temporary workers, and that's a huge red flag, because when companies get rid of temporary workers and don't replace them with full-time jobs, well, that means demand is plunging, and next to go will be the full-time workers.